Hello everyone. In this video, we're going to look at one of the popular form of investing in stock markets, that is index fund investing. So already I have talked about what are stocks, what is stock market, and what are mutual funds in my previous videos. So this is a continuation of that. So if you do not understand what are stocks or what are mutual funds, it's better to watch those videos. So I'll paste the link in the description for those videos. So you'll understand it better actually, what is mutual funds, at least what are stocks. Because I've given a very detailed explanation of all of this in my previous videos. So in this video, I'll focusing on just index fund investing, which has become quite popular now. So before going on to index funds, let me just revise some of the basics of stock market and mutual funds. So stock markets, or not stock market, stocks or shares are ownership certificates of a company. So if you are buying a share of a company or a stock of a company, basically you are becoming a partial owner of that company. And now, once you have become the partial owner of that company, now the share price of that share or stock increases or decreases based on the earnings of the company in the long term. So if the earnings of the company does well, the price appreciates for that stocks in the long term. But if the company does not do well, its earning keeps on decreasing year by year, then the stock price also keeps on decreasing. And equity mutual funds are those mutual funds which invest in bunch of stocks. So let's say 20 or 30 stocks or a subset of stocks from the stock market. So you have two choices. Either you can pick up the stocks on your own, that is direct stocks investing. So you see that, okay, this stock maybe is doing good, or basically you have analyzed that company, then you can buy the stocks of that company by yourself. Or otherwise, if you do not have that much time for reading about the financial reports of the company and analyzing the company, then you can give this thing to the mutual funds, where you have fund managers who have expert knowledge on these stock markets. So you can give your money to them and they will invest in the stock market. And also a very important point is that investing in stock markets or equity mutual funds does have risk. So stock market depends on the earnings of the company, right? And earnings of the company again depends on the economy of the country also. So if the economy does well, the company also will do well in most cases, and then the earnings will also do good. But if the economy does bad, then maybe the company also does bad, the earnings also do bad. Hence, your returns will not do good in that case. So that's the risk here. So in some cases, what have happened is sometimes stock markets, they have, fell by around 50% around sometimes in 2008 recession, or even in the current situation, if you see, due to coronavirus, the markets have fell by around 25 to 30% now. Now let's first understand. So before going into like what are index funds, so let's first understand what are stock market index. So you'll always hear some terms like NIFTY and sensex in stock markets. So let's understand what are these actually. So stock market index it consists of a subset of stocks from the stock market. So let's say top 50 companies of the stock market. So normally when we describe top 50 companies or top 100 companies, we compare it based on the market capitalization. So market capitalization is nothing, but if you take the number of stocks a company has or number of shares a company has, and if you multiply that to the stock price of that company, you get the market capitalization of the company. So basically, higher the market capitalization, bigger is the company. So in India, if you see, Reliance Industries has the highest market capitalization in India. That means it is the biggest company in India. Then you have other companies also which have very, quite high market capitalization in India. So this stock index can be like, for example, a list of top 50 companies or top 100 companies or mid cap companies or small cap companies. So mid cap companies are companies that invest in, companies whose market capitalization is in middle, not very high, not very low, in the middle. Small cap are like, if they are the lowest one. So basically, if you take top 200 companies by market cap, then you can classify the first maybe 100 as a large cap companies, or next 50 as the mid cap, and next 50 as a small cap company based on the market capitalization of the company. So we have SEBI in the India, SEBI. So that actually regulates the market. So so what they actually classify this. So which company will fall in large cap companies, which will fall in mid cap, or which will fall in small cap companies. And this stock market index actually helps in measuring the performance of stock market. So normally the two popular index are Nifty and Sensex. So when we say that, okay, Sensex has increased by 1% today, that means overall market is doing good. But that does not mean that all the stocks has risen by 1%. That does not mean that. If Sensex consists of, let's say 30 stocks, let's say, and this 1% increase is based on these 30 stocks. It may happen that in these 30 stocks, some five or six stocks would have fallen by some 0.5%. It can happen. Other stocks would have increased by 1%, 2%. But this 1% is the overall, basically, overall increase in these 30 stocks. Kind of average, if you can say. So yeah, you will always hear that Nifty went over by 1% or Nifty is down by 1%. So that's how basically people measure the stock market performance in the long term or every day. So I will take a live example, not like live example, but an example here to show you what actual index is. Taking example of Nifty 50 index, which consists of top 50 companies in India. So if you see here, I have taken this from the Nifty site itself. So if you see here, the number of constituents, number of companies is 50 here. The launch date of this index is 1996, April 1996. And there are other thing also, base value, other things. This should not matter to you. The main thing to look here is you should see here the top constituents by weightage. So which are the top stocks in this index? So I told you, right? Index is basically a subset. It consists of a subset of stocks. So if you see here, the top 10 stocks here are, so Reliance Industries is there, HDFC Bank is there, Housing Development Finance Corporation is there, Infosys is there. Similar, there are many other companies. So these are top 10 companies in this index, out of which Reliance Industries has around 11.5% weightage in this. Then HDFC Bank has 10% weight. So basically this index also, for each stock you have a weight. So basically, let's say if Reliance Industries increases by 2%, then the increase of overall index will be higher. Why? Because Reliance Industries has around 11% weight in this. That's why you have weight. And basically basically if you want to know the price of this index, so basically the price of this index keeps on increasing or decreasing, right? What normally they do is they take the free float market capitalization of each of these companies. So what do you mean by free float market capitalization? So see, even if Reliance Industries has, let's say, 10 lakh shares in the market, not all the 10 lakh shares are traded in the market, because some shares will be held by the promoters. Let's say Mukesh Ambani is having 50% of the shares of this company. So he is not going to sell his shares in most cases, right? So these 50%, shares are not trading in the active market. So these will not be considered. Only the active shares that are being traded in the stock market will be considered. Then basically you take the market capitalization of these stocks, and then you basically take a weightage average of this. So so basically Reliance Industries has 11.5% weightage, right? So basically its overall weightage in this index will be quite higher than the other stocks. So that's how you arrive at the price of this. So if you see here, also you can see the returns here. So since it has been, it has started in 1996 and returns here since inception at 9.79%. But this is not including dividend, because also these companies will also pay dividends. So if you include dividends, it should be around, I will say around 11 to 12% around, let's say, because if you see here in last 5 years, the return, total price return is 3.8%. But if you include the dividend also, it's 5.16, right? So around 1.5% dividend also, if you see here. So if you include since inception also, overall you will get around 11%, 11.5% returns. And yeah, and even if you see the sectors here, and one advantage of this index fund is that they are quite diversified. So they are in, let's see here, they are around 36% of the weight is from financial sectors. From IT, you have 14% weight is in this. Oil and gas, you have 13%. Similarly, you have a very diversified, I will say, index, or you have very diversified stocks in this. So you have 50 stocks. Out of the 50 stocks, most of the stocks are from very different sectors in the economy. So that's quite good. Now let's go to index fund. So at least now you understood what is basically stock market index, right? Stock market index is a subset of stocks, and every stock has a different weightage in this. So higher the weightage, higher its effect will be on the overall stock index price, right? Now, index funds are, so mutual funds that directly invest in the stocks of an index. So I told you mutual funds actually invest in a group of stocks. What if, let's say mutual fund invests in this group of stocks. So I have shown you have these stocks here, right? Reliance. So what if a mutual fund invest their money, whatever they are getting from the investors, in these stocks in the same weightage? That is 11% in Reliance Industries. So out of, let's say they have got 100 rupees, let's say from the investor. I'm just taking an example here. They have got 100 rupees from the investor. Now let's say if they are investing 11% of that money in Reliance Industries, 10% of their money in HDFC Bank, 8% of money in Housing Development Finance Corporation, then they are equal. They are basically mirroring this index, right? They are basically investing in same set of stocks in this index in same weightage, right? So they are basically replicating this index, right? So those are called index funds. So these funds invest in stocks in the same weightage comprising an index. That's what I told you. I will show you an example here. So if you go to Kuvera here, so Kuvera is one of the sites where you can buy and sell mutual funds. And maybe if you just type NIFTY here, so you should see a lot of, okay, I will just take, okay, this is next 50. Okay, let me take, I just want to take a index fund there. I mean, okay, let me take this one. So if you see, you will see the performance, everything here. And then if you go to holdings here, the main part is holdings. So if you see their holdings also, they have invested 11% of total money that they have got in Reliance Industries. Similarly, they have invested 10.59% in HDFC Bank, 8.808% in Housing Development Finance Corporation, Infosys 6.79%. Now, if you compare to this one, it's quite same, right? 11% here, 10%, 8% here, right? So they are basically investing in an index, that is Nifty 50 there. I have shown you the example of that. And this index fund try to replicate the performance of an index. So they try to replicate. It's not sure that, let's say the Nifty 50 index gives you a, let's say 10% return in 10 years. It does not guarantee that these funds that invest in the Nifty 50 index will exactly give you 10%. It may be around 10.5%, 11%, if 1% higher also, or 1% lower also. It can vary. It depends on actually a term called tracking error. So what is tracking error is that, see, actually they're investing in the same stocks, I agree, but there are some differences here. The differences here are that, see, when, let's say this, what happens in this index is that there are many stocks which enters this index and some stocks which go out of this index, because this is based on the market capitalization, right? So if a company does bad and its market capitalization decreases, then it may go out of this index and some new stock will come into the index. Now, this will happen on some day, right? But it's not sure that that mutual fund will change the portfolio of that index fund on the same day. I mean, they may change it on some fifth day, right? After 5 days after this change has happened, right? So there will be some tracking error in this case. Similarly, you have to pay some expense ratio in case of mutual funds. Let's say in case of index fund is quite slow. Let's say 0.1 or 0.2%, right? But still you are paying some money, right? Then you have dividends. So normally when you are tracking the stock market index, it does not account for the dividends. It normally you see the price returns, right? You do not see the dividend returns in when you see the stock market index. But here in mutual funds, when you have mutual fund indexing, right? So basically when mutual funds have index funds, in that they will also get dividends from those stocks like Reliance Industries, Infosys and all, right? So what they can do is they can again reinvest these dividends in the stocks again. So you may see some higher returns in this case. Another last case, due to some tracking error can happen is, so tracking error is basically, let's say the Nifty has, I told you, if is a Nifty 50 index has given you 12% return in 10 years, these index funds, either their returns will be, slightly lower or slightly higher, both can happen, right? So it may be like, okay, 0.5 or 1% lower or 1% higher, right? Because of these cases actually. The last one is if outflows is greater than inflows. let's say what happens due to some reasons, the market is crashing, people have started selling these index funds, right? So in that case, what will happen? The fund manager, it's very tough for him to decide, okay, which stock should sell or which stock should sell, right? It becomes tough for him. So in that case, there will be slight variance. So let's say Reliance Industries was 11%, right, in the index fund, sorry, in the index itself. So he may, I mean, maybe sell some Reliance Industries and its weightage may fall to 10.5%, let's say. It may happen for some days. But in long term, you will see that, okay, this will reflect the stock market index. But in short term, these fluctuations can happen. And that's why you can see slight change in the returns from these index funds. But this will not be very high. This will normally be quite low. I mean, maybe difference of 0.5% or 1%. Normally, we should invest in those index funds that has very low tracking error. If the tracking error is very low, they will basically replicate the performance of the index, I mean, stock market index itself, right? Now let's look at what are advantages of investing in index fund. So why you are hearing it, I mean, lot about index fund today, right? Everybody is telling you invest in index fund, but why? What are the advantages of this? So this is the most passive form of investing. Why this is passive? Because see, already you have the stock market index. The mutual fund manager just has to see this index and allocate this money according to it. And he or she does not have to actively manage this, because stock market index, the companies in the stock market index, they change quite, I will say, infrequently. Normally in 1 or 2 quarters, maybe a company may be removed from this index and some other company may be added. In that case only the fund manager has to do some active fund management, right? In that case only. So basically in quarter he or she has to change this stocks of these funds once, right? That's quite low. But active fund managers, what they do is they monthly or maybe on to, I mean, on the depending on the market conditions, they will actively change the stocks in their mutual funds portfolio. So that's quite active. And normally normally what we have seen is that 90% of the mutual funds are not able to beat their benchmark. So what is benchmark here? So this index, stock market index actually are the benchmark. For example, if the mutual fund is investing into large cap companies, then Nifty 50 will become the benchmark for it. Let's say if Nifty 50 has given 12% return in 10 years and that fund has given only 10% return, right? So it has not been able to beat that Nifty 50 benchmark, right? That is 12%, right? That's what we have seen. 90% of active mutual funds do not beat their benchmark. And these index funds are not active mutual funds. These are passive mutual funds, because the change happens very infrequently in this. Also, another advantage is expense ratio is very low in the index funds. So normally if you see in active, index funds, so not index funds, active mutual funds, you will see the expense ratio around 1%, 1.5%, 2%. But when you go to these index funds, index mutual funds, you will see the ratio can be as quite low as 0.1% or 0.2 or 0.3%. That's quite low, right? Okay, and if you do not understand what is the expense ratio and everything, I've already explained this in my previous videos on basics of mutual funds. You can watch those. And these index funds are quite diversified. As I've already shown you, right? These are like diversified in quite different sectors of economy, like financials, FMCG, other sectors of the economy. Take example of Nifty 50 that invest in top 50 companies of India, right? Then you have Nifty Next 50. So the difference is there. One is Nifty 50, another is Nifty Next 50. This invest in 50 companies from the bottom of top 100 companies. So if you take the top 100 companies in India, Nifty 50 is the Nifty 50 index, invest in the top 50 companies. And Nifty Next 50 company invest in the the bottom 50 companies. And basically these two constitutes the top 100 companies in the stock market, right? So basically you are invest through these index funds, basically you are investing in the top companies of India, top 100 companies of India, right? And what we have seen, what I have also seen is that these top companies keeps on capturing more market share from the companies which are smaller. That's what we have seen. Like example, you take Reliance Industries, they have now like Reliance Jio, Reliance Retail. Similarly, HDFC Bank is capturing the market share from other public sector companies. So these bigger companies are growing bigger and bigger every day. Now, what is the expected returns from these funds, right? From these index funds. So I am just talking about the large cap fund, that is Nifty 50 and Nifty Next 50. There are also other index funds like small cap and those. I'm not talking about those because the risk increases in those, because small cap and mid cap, they invest in small cap companies, right? So the risk increases there. So if you want, I mean, if you do not want to take more, so see, stock market is already risky, right? And if you do not want to take more risk, it's better to invest in large cap companies. So I am trying to see the returns here for top 100 companies only. So in the long term, you can get around 10 to 12% return. The long term here is around 10 plus years. So that's, you should understand, 10 plus years is long term for me, not 5 years or 3 years. Because if you see the 3-year returns, at least today, it will be, it's a negative 5 or 10% because of the coronavirus case. But maybe if this would not happen, you would have seen quite good, maybe 5-6% return, 7% return, maybe. But in a long term, you will get around 10 to 12% return. And okay, one more thing to tell is that this is expected returns. These are not guaranteed returns, right? You should understand this. Stock markets is risky. I mean, it depends on the economy and earnings of the company. So you are not going to get guaranteed returns like fixed deposit of 7 or 8% here, right? But expected returns. So if everything goes well, if economy does well, if India does well, yeah, you will get around 10 to 12% returns. So since this is risky, stock market risky, these index funds basically they are investing in stock market, right? So that's why these index funds also have some risk here. And if you normally see the risk appetite for this will be very high, because fixed deposit it does not have any risk. If you compare this fixed deposit, of course, the risk here is very high. So, so that's why my suggestion is that invest only that part of money that you don't need for next 10, 15 years. Only invest that part of money in index funds. Do not take risk with other money which you want to maybe use in next 3 or 4, 5 years for your child marriage, or maybe your child education. Do not put that in equity mutual fund, at least. So Nifty 50 index, it has given a 10 to 12% returns. I mean, dividends also here since its inception in 1996. Similarly, Nifty Next 50 index has given 14 to 15% returns. That's quite high, but there's a reason for it. I will talk about this later. Okay, I will talk about that now. So let's now see the Nifty Next 50 index. So I have already talked about Nifty 50 index. So those are top 50 companies, right? On Nifty Next 50 index consists of, from the top 100 companies, the bottom 50 companies constitutes the Nifty Next 50 index. Here again, you see everything. This also started in 1996, right? And again, if you see the returns here, it's around 14.5%. That's excluding dividend. If you include the dividends, it may be around 16%, right? So that's quite high, right? Why it is high, I will give you a reason. So the stocks here, if you see here, so you see dividend yield is 1.37%. So if you just plus that into 14.5, you get around 15.5, around 16% return. That's quite good. And the risk also here increases than the Nifty 50 index. So one thing you should remember in investment, higher the returns you are getting, higher the risk you are taking. Always, this is always the case. So if you are seeing here higher returns, so this will have higher risk than the Nifty 50 index. Because Nifty 50 index was only giving you 12% return. This is giving you 16% return. So the risk here is higher. Why? Because the stocks here, so this is also index fund. This will also invest in some stocks, right? If you say the stocks are Avenue, Supermass, Davies Laboratory, HDFC Life Insurance. So this Nifty 50 index invests in emerging sectors or the companies which are growing very fast. Since they are growing very fast, the risk involved is also high here. So either they will, so the risk here is, so either they will do so, keep growing fast and fast, right? So they will do well. But the downside is also here is high. It may also happen that since they are trying to grow fast, very quickly, they may also fall down also. And this happens quite, this keeps on happening in stock market, you will see. But the risk here is, and since you are taking more risk, you are also getting more returns. So here you have stocks from emerging sectors like life insurance, health insurance, retail. Then these companies also have potential to join the Nifty 50 index, right? Because these companies can become bigger and bigger and bigger, and at some moment they may become part of the Nifty 50 index. And these have again very high growth potential. And these companies normally have very high valuation. than the Nifty 50 index companies. So, okay, for valuation, actually PE, so price to earnings multiple, is one of the parameter for defining valuation. And if here, if you see, it's 64.88, and in case of Nifty 50, it was around 25 around. So if you see valuation of the companies here is also high. So the valuation is high because the market is basically, they are thinking that these companies will grow very fast. So they are giving these companies very high valuation. And the Nifty 50 companies, they think that, okay, they will grow quite slow, maybe around 10%. So they are giving them low valuation. Now let's talk about, okay, I've talked about index funds, Nifty 50 index, Nifty 50 index. Now let's talk about some of the popular index funds that are available in the through mutual funds industry. So in the Nifty 50, if you want to invest in Nifty 50 index funds, so you have UTI Nifty Index Growth Diet Plan, ICICI Prudential Nifty Index. So what you can do is you can directly go to Quivira actually. So here you can search for this. Sorry. If I go to home page. Okay. Okay, invest mutual funds. I think they should show me. So if I just write Nifty, you can see, right? This is IDFC Nifty. There are many actually here. Similarly, if you write Nifty Next 50, you will see more. You will see the index funds that have invested in this Nifty 50, Nifty Next 50 index. So you can see here. So Nifty Next 50, I will say there are 4 or 5 only, but for Nifty 50, you will get a lot of mutual funds. Some of them popular ones I have mentioned here is, so popular one I have so I have taken here the expense ratio into consideration and also the tracking error. Based on that, UTI Nifty index fund is quite good. So okay, I will talk about in which index funds I have invested. Then you have ICICI Prudential Nifty Index Growth Diet Plan, and then you have HDFC Index Nifty 50 growth. So these are for the Nifty 50 index if you want to invest in Nifty 50 index mutual funds. But if you want to invest in Nifty Next 50 index funds, then you have, again, from UTI, you have Nifty Next 50 index growth plan, and you have again from ICCI Prudential Nifty Next 50 index growth plan. Let's discuss about in which basically funds I have invested. So I am normally doing SIP. So SIP is every month I invest some part of, let's say, my salary in this index fund. So I am basically, let's say if I decide that, okay, I want to invest 5,000, then what I do is I invest 5,000 in both of these funds, Nifty 50 index fund and Nifty 50 index fund. So Nifty Next 50, it's actually confusing. Both names are same, only next is different, right? So I invest, let's say 5,000 in Nifty 50 index fund and 5,000 in Nifty Next 50 index fund, right? And for my purpose, I have selected UTI Nifty fund and UTI Next 50 index fund, both of this, because they have quite low expense ratio, and also the tracking error for this is quite low. So they will, in the long term, they should be mostly able to replicate the performance of the stock index, that is Nifty 50 index or Nifty Next 50 index. And yeah, and one good thing about, I want to tell one good thing about this investing, right, in index fund is that it is the easiest form of investing in stock market, right? So the easiest way is through mutual funds. But again, mutual funds have active funds as well as passive funds. So these are the passive funds, and these are the easiest way, right? So basically, whatever returns the stock market, that is Nifty or Sensex, gives in long term, you are also going to get the same returns. And as I told you, 90% of the mutual funds are not able to beat these returns by Sensex and Nifty, right? Only 10% of the 10% of the mutual funds are able to beat it. So now, to find these 10% of these funds, you have to do a lot of research, right? To find these funds. Again, you have to take a lot of time, go through these funds, right? And these active funds keeps on changing the stocks in them based on, different time intervals, right? They are quite active. And even if, let's say, they have given good returns 5 years, but since they are quite active, right? Now they may get a new fund manager, and the new fund manager may maybe buy some different set of stocks, and maybe that mutual fund will do bad in next 5 years. That can happen. So it's very, I will say it's best to invest in index funds. So if you do not know much about stock market or mutual funds, but you should know some basics of what is mutual fund and stock market. That's why I have made video on that. You should know basics, but you do not want to research a lot into this, right? Now your aim is not to invest directly in a stock, so you go through the mutual funds route. But even in mutual funds, you are finding a lot of funds. You get confused. Okay, for this, you have thousands of mutual funds for equity. I mean, so which funds to select now? You get confused, right? Now you have to do a lot of research to find out, okay, which has done well, which, I mean, you have to see the stock, everything you have to see here, right? A lot of time is involved in this. Why not have a passive form of investing in index fund itself? You do not have to take a lot of tension here. You do not have to worry about the fund manager itself. Because fund manager is actually doing nothing in this, right? He or she is just changing the stocks in that depending on the stock market index, that is Nifty 50. If some stock in Nifty 50 changes, he or she has to change the stock in the fund also. That's quite simple, right? So yeah, that's why I prefer index funds as one part of my portfolio, because it's passive, and also if I invest directly in stock market, I also can track my returns through these index funds. And if you have any questions regarding to index mutual funds, or any questions if you have, feel free to put it in comments. I will surely reply that. Thank you.